Right now, the U.S. government is actively executing a plan to legally drain over $13,000 from every $100,000 you have saved, and they are doing it without raising your income taxes a single penny. This is not a conspiracy theory, and it is not a political talking point. It is a documented macroeconomic strategy called financial repression, and right now, the Federal Reserve is quietly setting the trap. In this video, we're going to expose the exact math behind the government's terrifying debt spiral. Then we will uncover the hidden regulatory loophole the Fed is using to artificially suppress yields and steal your purchasing power. And finally, I'm going to give you the exact 3 ETFs you must own to shield your portfolio and actually grow your wealth while everyone else gets silently wiped out. Now, if you think this sounds like retail panic, let me stop you right there. I have spent hundreds of hours analyzing the sovereign debt markets, building data-driven tools for serious long-term investors, and digging through the fine print of central bank policy. This analysis is grounded in a meticulously documented policy pivot recognized by global financial authorities. Bridgewater Associates, the world's largest hedge fund, explicitly warns against holding nominal bonds right now, stating that central banks will artificially cap yields, which makes cash terrible to own and great to borrow. Furthermore, BlackRock, the absolute largest asset manager on the planet, explicitly highlights the shift toward fiscal dominance and the absolute necessity for the government to use financial repression to manage its debt burden. Even the Congressional Budget Office projects that by 2031, the interest rate paid on federal debt will permanently exceed the rate of economic growth. We are on the undeniable path of a sovereign debt spiral, and the macroeconomic playbook they are using right now exactly mirrors the post-World War II era from 1942 to 1951, where the Fed pegged short-term bills near zero and capped long-term bonds while inflation spiked into the double digits. Like and subscribe if you enjoy content like this and want to see more. Let us start by looking at the terrifying reality of the balance sheet. Most people know the government is in debt, but human brains are not wired to comprehend the actual velocity of the current crisis. Imagine a leaking faucet, but instead of water, it is dispensing hundreds of thousands of dollars every time you blink. Right now, the U.S. gross national debt sits at a staggering $38.86 trillion. That puts our debt to GDP ratio at 124.30%. But the absolute most terrifying metric is the velocity of this issuance. The government is currently taking on new debt at a rate of $83,720 per second, every single second of every single day. And with the recent passage of the One Big Beautiful Bill Act, or OBBBA, projections show the debt-to-GDP ratio rocketing toward 190% over the next 35 years. So how does a government survive when it owes more than its entire economy produces? It cannot simply print money overtly, because that causes immediate hyperinflation and riots. Instead, it uses a stealth operation. To understand how they steal your wealth, you have to understand how a magician performs a card trick. They force you to look at their left hand while their right hand palms the card. The public is entirely focused on the Federal Reserve's headline interest rate decisions, but the real manipulation is happening behind closed doors through regulatory engineering. Instead of overt money printing, authorities are using a strategy called shadow yield curve control. They do this via a very specific, highly technical loophole known as the supplementary leverage ratio, or SLR. By quietly changing the SLR regulations, the government instantly frees up $219 billion in bank capital. This massive unlocking of capital allows commercial banks to step in and absorb trillions in U.S. debt. By forcing banks to buy these bonds, the government artificially suppresses long-term interest rates. They are rigging the bond market so they do not have to pay the true, massive interest rates that the free market would demand for such a risky borrower.
So how does this shadow manipulation actually hit your wallet? Let us look at the retail investor who thinks they're playing it safe. You've worked hard, you've saved your money, and you decide to put it into a seemingly secure nominal bond, paying a decent yield. You think you're protecting your capital, but under financial repression, you're walking right into a mathematical slaughterhouse. Let's run the exact numbers. Imagine an investor holding a 4% nominal bond. First, you have to pay taxes on that yield. Assuming a 24% marginal tax rate, your actual take-home yield immediately drops. But then comes the silent tax, inflation. If the real-world inflation rate sits at 4.5%, which is exactly what the government wants in order to inflate away their massive debt, your real return is violently negative. In this exact scenario, you suffer a negative 1.46% real annual return. Over a 10-year period, a $100,000 portfolio in this exact safe scenario will lose over $13,600 in actual real-world purchasing power. You didn't lose any physical dollars, but your ability to buy groceries, housing, and energy has been permanently erased. If bonds are guaranteed to lose you money and cash is practically melting in your bank account, where do you hide? You can't just buy any random stock because rising input costs will crush weak companies. You need businesses that act like toll bridges. Imagine a bridge that everyone has to cross to get to work. If the toll bridge owner's costs go up, they just raise the toll. The drivers complain, but they still pay because they have no choice. That's called pricing power. You need high-quality enterprises with immense free cash flow and the ruthless pricing power to pass all of their input costs directly onto the consumer.
But finding these companies one by one is risky and time-consuming. Instead, you can buy a single fortress asset that systematically filters for this exact profile. It applies a brutal, unforgiving hurdle. If a company has not consistently paid a cash dividend for 10 consecutive years, it is entirely banned from the portfolio. The exact asset that executes this fortress strategy is SCHD, the Schwab U.S. Dividend Equity ETF. While a fortress is great, you also need an asset that actively fights back against inflation. You need income that grows faster than the government can print money. This brings us to the concept of dividend growers. But there is a massive trap hiding in the dividend world. Many novice investors look at a stock paying an 8 or 10% yield and think they found a gold mine. In reality, that massive yield is usually a distress signal. The company's stock price has collapsed because they are drowning in debt and a dividend cut is imminent. This is called a yield trap. Spotting these toxic yield traps before they destroy your portfolio is exactly why I'm building FluxYield and why you should join our free Code Invest Studio Telegram community. Inside, we share actionable ETF and dividend strategies every week, and our Telegram members will be the only ones getting early access to the software. The link is in the pinned comment. Now, to survive the 2026 wealth wipeout, you need an automated system that hunts for aggressive dividend growth, but mathematically protects you from distressed garbage. There is an incredible fund that does exactly this. It strictly targets companies with a proven history of growing their payouts year over year, making it a dynamic inflation hedge. But crucially, it has a built-in safety mechanism. It automatically excludes the top 10% highest yielding stocks in the market to ensure you never step on a yield trap. That specific fund is DGRO, the iShares Core Dividend Growth ETF. For our final layer of protection, we have to step outside of traditional equities and look at real assets. When inflation rips higher, commodities like gold, oil, and agricultural products skyrocket. The amateur move is to buy the physical commodity or a heavily indebted mining company. The problem with a gold miner is that when the price of gold goes up, the cost of the diesel fuel for their trucks goes up, and the wages for their workers go up. Their massive operational overhead eats all the profit. The genius move is to invest in the guys who finance the miners or the exchanges where the commodities are traded. These are called asset-light real asset companies. Think of royalty streaming companies or financial exchanges. They benefit massively when the price of the underlying commodity rises, but they have extremely low static operational overhead. This creates something called massive operating leverage. Every new dollar of inflation goes straight to their bottom line. To capture this exact sophisticated strategy without having to do the complex stock picking yourself, you want an actively managed fund built specifically for this macroeconomic nightmare. The exact ticker is INFL, the Horizon Kinetics Inflation Beneficiaries ETF. Now, building this fortress portfolio is step 1, but maintaining it is step 2. That is exactly why I opened up our free Telegram channel. When you join, not only do you get weekly actionable dividend tips, but you also secure your spot for the very first feature we are shipping inside FluxYield, the Dividend Safety Sentinel. Think of it as an institutional-grade health scanner and asset screener for your portfolio. It constantly analyzes cash flow and debt to warn you about dividend cuts long before the market reacts. Click the link in the pinned comment to join the community and get on the list. But shielding your wealth with these 3 ETFs is only half the battle. If you are blindly dumping your remaining cash into the standard S&P 500 index right now, because that is what everyone else does, you might be walking right into a massive concentrated valuation trap. To see exactly what happens when you put $100,000 into VOO versus SCHD over the next decade, click the video on your screen right now. It is the only way to make sure your core portfolio survives the coming shift. Click it now, and I'll see you there.